All right, a very good morning, everyone. Thank you for joining us from wherever you are joining us from across the world. We're delighted to have you for this sixth installment of the Africa Business Energy Series hosted by Africa Business. My name is Wale Famiro. I'm honored to be your host and moderator for this webinar. Of course, we're entering 2026 at a critical crossroad. 2025 was a year of what many would describe as energy realism, marked by volatile oil markets and tightening debt constraints. And today we look forward to unpacking what the outlook is for 2026 against that background. So we're delighted to have many distinguished speakers who will be providing very useful insights that you can bank and use this year. And hopefully it will be a valuable 1 hour of your time. So once again, we say welcome to everyone joining us across social media. We look forward to a great event today. So without further ado, I would just like to kick things off and get things rolling and invite Ben Payton, Energy and Infrastructure Reporter at Africa Business, to set the scene for us as he speaks to the trends shaping the energy industry in 2026. Ben, the floor is yours.
Thank you very much, Wale, and hello to everyone around the world. I'm just going to share some slides, which I hope everyone can see. Good. So I'm going to share some of my reflections on the key trends that we can look forward to this year in the African energy industry. And the first point I want to highlight is that in terms of the megawatts of electricity generation capacity that will be added in Africa in 2026, really there's very little doubt that the lion's share of that is going to come from solar energy. So far, Africa has really only scratched the surface of what's possible with solar. Africa still receives only around 2% of global solar energy investment. So although the continent is still at a low base, the good news is that things are accelerating. And this year, we can be fairly sure that several very large utility scale solar projects will come on stream, particularly in places like South Africa, Morocco, Egypt, large markets where investors can achieve significant scale. For example, in Egypt, we're going to have a project led by AMEA Power, which will be the largest single solar and battery energy storage project coming online this year. Alongside that kind of top-down trend, I think what's really interesting is that there's also a bottom-up revolution here, with more and more households and small businesses installing solar panels to generate electricity. So the energy think tank Ember has collected some data showing that in the 12 months to June 2025, solar panel imports, Chinese solar panel imports into Africa increased by 60%, which is quite dramatic. And it's also far larger number of panels being imported than will be used in utility scale projects. So what's happening here is that more and more people are realizing they can save money by putting a solar panel on their roof and therefore using their diesel generator less often. And if they can also afford to purchase a battery as well, they can get a fairly reliable supply of power. And as the cost of panels and importantly of battery storage continue to fall this year, there's every reason to believe that that trend will accelerate. What's interesting, though, is that some energy system planners are actually quite nervous about this. They're nervous about the effect it could have on the financial health of the utility companies. And even in Nigeria, the government has even considered banning or restricting the import of solar panels. So it's an issue that's going to get more and more attention this year. Also in the solar space, another trend I'll highlight is the growth of commercial and industrial solar power. If you speak with major companies in sectors like mining or data centers, they're all very enthusiastic about using more solar power for their operation simply because it's cheaper for them. And also with CBAM, the EU's carbon border tax coming in, they can have competitive advantages if they're exporting to the EU through using cleaner energy. So one of the things, however, that's been holding C&I solar back in Africa, in most African countries, is the difficulty in wheeling. And for those who aren't familiar with wheeling, this refers to when a company might have a facility in one location, it purchases solar power generated in another location, and then it uses the national electricity grid to transfer or wheel that power. And wheeling really opens up possibilities for C&I solar, and indeed for wind as well. Because if you don't have the ability to wheel electricity, then you're really limited to generating power from sites that are adjacent to your facilities. So far, South Africa is the one African market to have really fully embraced wheeling, and it's proved very popular with industrial power users, and we see the market there becoming more and more sophisticated. Other countries are at various stages of considering whether or how to implement wheeling. Kenya is probably the most advanced after South Africa, and that's something I expect to become a bigger agenda item this year as governments look at their regulatory frameworks there. Now, turning to oil and gas, in many ways, 2026 will probably look like a successful year for the oil and gas industry in South Africa, because several major projects are going to come on stream and others will progress towards development milestones. And one I'll highlight is Uganda. So 20 years after oil was discovered, it looks likely that Uganda will begin oil production this year with the French company Total and the Chinese company CNOOC producing and then exporting through the East Africa crude oil pipeline. In Mozambique, Total lifted force majeure on its huge LNG project late in 2025 that had been imposed because of an insurgency in the area. So there's still a few technical and financial milestones to complete, but it looks like development work will restart on that, which could bring forward really the date when Mozambique becomes a globally significant LNG producer. And then on top of that, there'll be several large projects in existing major oil and gas producers like Nigeria, Angola coming on stream, which will bring production levels in Africa to the highest they've been perhaps for several years. On the other hand, certainly still challenges with financing and some really major potential projects where the future is still not certain at this stage, particularly Namibia, where very, very large offshore discoveries have been made in deep water. And it's not completely certain when or if indeed oil and gas companies will commit to taking those into production. And that's really a project, an issue of project economics. The cost of developing these kind of projects, particularly in areas where there isn't existing oil and gas infrastructure, where there isn't necessarily well-developed regulatory frameworks, is very high. And countries like Namibia really have a mountain to climb to persuade oil and gas companies to make those enormous investments that are needed. European DFIs, development finance institutions, which are typically some of the major funders of African energy projects, a lot of them have restrictions on funding gas and certainly oil projects in Africa. So there's a need to look for other solutions. The US Trump administration has been much more enthusiastic about funding oil and gas. It's been important in restarting the Mozambique LNG project. And also this year, it looks like the African Energy Bank, which will be headquartered in Abuja, with a capitalization initially of $5 billion, is going to enter into operations. And it will be interesting to see how significant that new bank is going to be as a player in financing. I also want to highlight that a number of countries are looking at alternative energy technologies. I think it's going to be an interesting year for nuclear power. The construction of Africa's second nuclear power station at El Daba in Egypt is well underway. They've recently installed the first of 4 reactor vessels there, and that's set to start generating power in 2028. South Africa is also looking to expand its use of nuclear power. It is aiming to add 10 gigawatts of new capacity over the next several decades, starting with a site existing to its existing power plant at Coburg. And then the two other countries that are making serious steps at the moment towards nuclear power are Kenya and Ghana. Both those countries at the stage where they're looking to identify specific sites, and in theory, construction in Kenya could even begin as early as next year. An important factor is the World Bank. Last year, it revised its lending policies towards nuclear power, which will make it easier to mobilize finance, particularly for the smaller modular reactors that could become very significant in meeting the energy needs of African countries. And then finally, I want to highlight geothermal, which is quite rare as an energy technology, and it's supported by almost everyone because it's green and it also provides baseload power. Kenya is by far the leading country in Africa for geothermal. It's actually number 6 in the world in geothermal production. And this year it's going to upgrade one of its existing facilities and open some new ones in the Rift Valley. I think the big question for geothermal in Africa is whether other countries are going to be able to follow Kenya's lead. Ethiopia has fairly similar geology. Developments there, however, have been repeatedly set back by what we might call above ground risks. Several projects are in the development stage, and the timeline there is still uncertain. So it's certainly going to be an interesting year for energy in Africa. That's perhaps the one thing we can say with certainty. And I'll wrap up there and hand back to Wale. Thank you.
Thank you very much, Ben, for that comprehensive overview. I mean, you can only say so much in a couple of minutes, but very valuable insight into what's going on across the continent and what we can expect in 2026. So thank you so much for that. As we move on now, we would be engaging someone you can describe as a true titan of Africa finance. He's the managing partner at Southbridge and the former president of the Africa Development Bank. He's been a primary architect of the continent's economic strategy for decades. He has played certainly a very important role. And I would like to now hand over to the publisher of Africa Business, Ben, who would be moderating this fireside chat. So it's over to you, sir. Omar, sorry. Apologies.
Thank you, Wale. Dr. Kabaruka, it's great to have you amongst us today. And as Wale said, you are an architecture of Africa's development and Africa's investment landscape in many respects. Can you hear us, Dr. Kabaruka? I'm not sure if Dr. Kabaruka can hear us right now. Let us just wait 1 or 2 seconds. Seems to be a connection issue. Okay, so maybe we'll go back to the panel and then we'll come back to Dr. Kabaruka if he's...
Sure. I think that works. Hopefully we can fix that, unless, of course, in the next few seconds we can reestablish contact with Dr. Kabaruka. I think it might make sense for us to move on to the panel session, and I'll come back to you, Omar, later on. Looking forward to that engagement. All right, so as Omar said, we are now moving on to a panel conversation where we look forward to getting the views of distinguished people in the energy space on the African continent, providing some valuable insight into what we can expect in 2026 as we look back at 2025. So first, I'd like to bring on Paul Early-Taylor. He is the gas sector lead at Standard Bank. He brings what you can call the boots on the ground insights of Africa's largest lender. Paul, given the global environment. We look forward to hearing your thoughts on what to expect in 2026. You're welcome, Paul.
Oh, sorry, was that a question? I thought it was just an
No, it
introduction.
wasn't. I just wanted to say you're welcome. It's fine. We'll get into the questions shortly. I just wanted to be sure we could connect.
No.
All right. And then, of course, we would be also having Mr. Reginald Max, Senior Advisor at the Trade and Development Bank. Reginald, TDB is at the forefront of the PPP models we need right now. We look forward to hearing more from you.
Thank you. Thank you very much. I look forward to the discussion.
All right. And also joining us today, we have Emma Gordon from the IEA. Emma, we look forward to hearing your insights as well.
Thanks for having me. I'm looking forward to the discussion.
All right. And last but certainly not least, we have Dr. Amin Idris, Director of Economy, Infrastructure, and Trade at the AU Development Agency, NEPAD. Dr. Amin? All right. Hopefully, Dr. Amin would be joining us shortly. But let's get started. Okay, so I would like to go first to, I think I'll go to Paul. And maybe you can help set the tone for us. So let's focus on the deal-making landscape this year, focusing on the commercial landscape. So given the context that we are seeing in the global environment today, how do you see Africa Energy's industry deal-making and project financing this year?
Yeah, so from the gas perspective, I'll probably mention about 4 producers or potential producers and a couple of importers. So first one to kick off is really Nigeria, where the decade of gas did have a slow start, but is now starting to make some real progress. There's a lot of backfilling of the Nigeria LNG, which of course is going to go to Train 7 this year. You also have a number of floating LNG developments in the pipeline, so let's see where they go. Mozambique was mentioned in the introduction. This is fantastically important this year. Resumption of construction by Mozambique LNG, hopefully Rovuma LNG will take FID. So you add Mozambique all together, you get to 38 million tons of construction or operations by the end of this year, and it all should be operational by about 2030. That would take Mozambique to number 4 in the world as it stands, but of course Nigeria may overtake it. That's going to be fantastically important, but also the domestic gas arising from each of Mozambique LNG and Rovuma LNG will be really important in terms of, can it be turned into power? Can it be turned into other things? Maybe data centers, so that's going to be exciting. Côte d'Ivoire is interesting. The Baleine field is now 2 phases online, potentially a third being developed. The main issue with the gas is, can the Côte d'Ivoire develop a sector that's broader than just electricity, and can it have the policy, regulations and so on put in place? And then there's Namibia. Lots of discoveries being made. We're in the early 20s. There's DSTs ongoing at the moment. This year, at least 2 players will do appraisal wells, and then you have the Total FID, and Total's just farmed into the Galp block. So during the course of this year, there should be more information known around the gas in Namibia. Is it all going to be reinjected, or some of it, will it become floating LNG, or even be landed? And then from the import perspective, 2 countries really pop up as exciting. South Africa, its gas to power scheme has been relaunched. This time around, it looks bankable. 2 gigawatts of gas to power, which over time will be expanded. The country expects 17 gigawatts of gas to power by the late 2030s. And you've also got industrial users. And then also Senegal finishing off. It managed to achieve fuel switching of heavy fuel oil to LNG in its power barge during the course of last year. And that perhaps can be a role model for other African markets. I'll pause there. Thank you.
No, thank you. Very useful lay of the land update there. But what about the oil price? Given where it's at now and the outlook for that, to what extent do you think this could impact deals this year, Paul?
From the clients that we do business with, most guys normally screen transactions at $40 from a downside sensitivity, even if their base case is in the region of 60 to 70, something like that. So at the moment, there's no real impact on long-term investment horizons from the clients we talk to. And on the LNG perspective, clearly most guys will be in the construction period, with the exception of Mozambique LNG at the back end, when the LNG really comes online over the next 24 to 36 months, as much as 200 million tons. So really it's the LNG price of the early 2030s that's going to be important to individuals. Thanks.
Thank you so much, Paul. Let me move on to Reginald now to get his thoughts on the modern utility. Reginald, would you say the modern utility in Africa is still bankable for hydro-reliant cross-border trade? How do you see that evolving this year?
I think it's a complex question in that I think.
Hello? For whatever reason, I can't hear the moderator actually. Is that normal?
We can hear you clearly. Hopefully, we can fix that for you shortly.
Can you hear me?
I can hear you, yes. Amin. Can you hear me? All right. Okay. Go ahead, Reginald. Sorry.
Okay. If I can continue, I think the modern African utility has changed. I think there were clearly certain events and circumstances in 2025 that I want to address what they look like going forward. I think it's important to say that Africa's transition cannot be delivered without a functioning utility and a grid. And yet what we find is several utilities are financially distressed, politically constrained, structurally unfit for the energy system, right, which is increasingly built by independent power producers. I mean, what you find has been the advent and the importance of IPPs in that. And what you're also finding is that the utility is no longer the default builder of generation, right? It's increasingly a buyer of power through PPAs, a dispatcher of electrons, if you want to call it that, and really an interface between policy and consumers, right? I think the central question we need to ask ourselves is not so much whether the utility remains relevant, but what it needs to do in order to restore bankability, expand the access, and basically have a development first, transition. But having said that, and all the pressures to utilities, I think the question we need to ask ourselves is, what's the future? And I think, the most likely outcome going forward into 2026 is that utilities will not disappear, but rather their transformation will be much more significant into different kind of functional models, because I think there's a discussion right now on how to reform the utility, the modern utility today, because it has changed. So the idea of the vertically integrated monopoly, which owns generation, dispatch, and sales to consumers, will continue to erode. We're going to find the continual breakup of utilities. And I think what you find is a more modular system where private generation will grow through IPPs, and really the utility will become a platform and a system manager where it determines rules, the credit enhancement, and ensuring that it develops the tools for balancing investment and affordability, especially in poor communities, right? So what you'll find is the utility evolving into a network system operator, its mission really driven around maintaining, expanding transmission and distribution, managing dispatch, load centers, and its revenue will increasingly be stabilized through network charges, collection systems, and service provision. That's how I see the modern utility going forward and how it's going to evolve going forward. I'll stop there for now, but there's a lot to talk about with regards, what the utility will look like. Mini grids, captive generation, for example, will continue to expand. But what's going to be key is cross-border trade, right? I think that you find with the advent and success of the Southern African power pool, credible settlement systems and sovereign performance, if you want to call it that, you don't need to own the cow to enjoy the milk, in a sense. That particular kind of conundrum will become very real, where you'll find energy, countries with significant surpluses of energy will start selling via the power pools into countries with huge deficits. Angola, for example, Mozambique, for example, South Africa will become major exporters of electrons. And you'll find Zimbabwe, Zambia, to a certain extent, DRC will become importers, especially in the context of 2026 going forward. Until obviously DRC sorts out its Inga issues, it will continue to be a net importer of electrons going forward. Thank you.
A very brief answer to this, hopefully, as a follow-up comment. What do you think is the impact of the increasing adoption of solar power on consumer and small business scale? How do you see that impacting demand for grid power?
There's a current discussion which has been circulating for some time, and there's a school of thought that suggests that solar power or renewable PV solar power is not the engine for industrialization. And most African countries right now has aspirations for industrialization. And the question is, do you industrialize through solar, or are you looking at base load, to be able to do that? That's where gas comes into its own, to a certain extent, hydro and other sources of power. What you will find, I think, is a continued movement away by the consumer base to independent mini grids, to distributed power systems, where the reliance on the grid or the reliance on the utility to provide that base load for consumers will continue to decline. However, I think demand from industrial users will continue to grow, especially the mining majors who are looking at 24/7 power across the board. Thank you.
Thank you, Reginald. A valuable insight there. Okay, Emma, I'll come to you now. So from the IEA, I just want to hear your perspective on this. Looking at the Mission 300 initiative, rather, how do you think we can ensure this translates into meaningful energy access across the continent? Emma? Sorry, we can't hear you right now for some reason.
You can't hear me?
I can hear you now.
You can hear me again? Okay, great. So Mission 300 was launched at the very, very end of 2024 as an initiative by the World Bank and the African Development Bank to provide electricity to 300 million people without access today by 2030. And we've seen this as a really important development last year to keep attention on electricity access. And there are still 600 million people without access on the continent today. And this links into the point that Reginald was making about increasing demand and things like that. Providing electricity access to this group of people will be very important for this sort of demand stimulation objective, and indeed to support utility health. But we know that providing electricity access means more than just small lighting systems. And we need to make sure that these consumers can step up the energy ladder, as we call it, and increase consumption over time, including economic activity, productive uses, etc. So the IEA charts a pathway to universal electricity access where 45% of the 600 million people without access today gain access via the grid. And that's particularly important because on grid systems, communities can indeed easily increase consumption over time. But we also flag that affordability is a real constraint. So today, about 40% of those without access wouldn't be able to afford even basic services. So those even just basic lighting systems. So we need to make sure that it's not just about financing electricity access projects, but also making sure that we consider affordability. So looking forward, I think some of the major challenges, and these tie in not just to electricity access projects, but more broadly, we've spoken quite a lot already about the role of solar, the role of utilities. Something that hasn't necessarily been mentioned, including in the presentation earlier, is about grid finance. We know that's a priority for a lot of countries. And we know that there are a lot of constraints. These are difficult projects to finance. And we've also seen last year a trend that I think we'll see going forward around supply chain constraints for grid financing across the world. Today, it takes 2 to 3 years to procure cables, 4 years to procure transformers, 5 years for HVDC lines. So something we really need to think about in all of these conversations, not just about access, but is also how grid financing can move forward and how we can ensure that the grid is there to support all of the other electricity generation needs.
Thank you. Very strong point there. Okay, Amin, I'll come to you now. And after this question, I just need to apologize to our panelists. We need to go back to Dr. Kaberuka because he is standing by, and then I'll jump back into the panel. But Amin, I want you to comment on this. Addressing the $20 billion plus investment gap in Africa is something I imagine is at the forefront of the Africa Union's programs. So how is your agency working to de-risk projects to attract private capital in the volatile global market that we play in today?
Thank you, David. Maybe before I address the question quickly, I want to comment a little bit on what Max was saying, especially about the solar or not solar, because there is a school of thought that absolutely says that you can't industrialize with renewable, especially solar. But we believe that it's not just about industrialization, it's also really about energy sovereignty. Because the more actually you increase access, definitely, then you can eventually move even your transport system to EV. Look, when you look today into African imports, 40% of our imports are about energy, basically. It's about oil and gas, because that's what we are using for transport. And we are importing inflation. So by investing more in solar, even at the domestic level, and then by also making rules and regulation a little bit much easier so we can actually move our transport system to electric vehicles, would reduce our exposure and we gain actually more sovereignty in terms of access to, not only access to energy, but also reducing our import. So let me now go back to your question about what we are doing in addressing the 20 billion investment gap. But maybe I think it's important to correct the scale of the challenge here, because the FDB estimates our infrastructure financing, generally speaking, between 50 to 90 or 90 to 120 billion. That's actually depending on who speaks, basically. And to bridge this in 2026 at ODA NEPAD, we have actually pivoted from seeking aid to domestic resource mobilization. That's what actually we think, because the shift was solidified last year during our summit in Rwanda, the Rwanda Financing Summit. It was really a turning point where we have moved from pledge to deal making. That's number one. And then we have secured a commitment for priority projects of PIDA, number two. And we have actually really engaged AMFI members, the Alliance for Multilateral Finance Institutions, themselves with our member states, so they can invest into de-risking investment using African capital first, because that's actually how we can bridge this gap. We are moving to aggressively implement as well the 5% agenda, where African pension funds and sovereign wealth funds currently hold about 1.8 to 2 trillion in assets under management. So it's important. So we believe that by channeling just 5% of this into infrastructure via our institutional investor public partnership framework, we can really unlock nearly 90 billion in domestic equity. And this is really our primary de-risking tool. When African institutions have skin in the game, I would say, global private capitals would follow, definitely. So now, if we extrapolate that on investment trends, we are modeling this on the maturity seen in many other countries, especially in the West, Australia and Canada, where pension funds allocate between 5 to 15% of their portfolio into infrastructure assets. So the leverage effect of this, actually $1 of domestic equity, basically leverage 3 to 4, up to $5 of private debt, actually. And that means that our 90 billion domestic injections can catalyze a total investment envelope of over $300 billion. And that would effectively help to close the gap without increasing sovereign, I would say, foreign currency debt. And then you have as well the Forex risk mitigation. by funding equity tranche in local currency, especially Naira or Rand or Shilling or even CFA in West Africa, would insulate those long-term assets from dollar volatility that has historically really paralyzed African projects. That's actually what I will say shortly, because we want to move to Dr. Kaberuka. I will come back actually later to speak about what our position on Mission 300 as well. Thank you.
It will be great to hear your thoughts on that, and thank you so much for your understanding. As I now hand back over to Omar to engage Dr. Kaberuka, and we'll come back to round up the panel in a bit. Omar, it's back to you.
Thank you so much, Wale, and thank you to our panelists. That was extremely enlightening. So, and you mentioned so many interesting points there, Amin, in terms of channeling domestic resources or domestic resource mobilization from our pension funds to infrastructure, towards infrastructure. The AFDB is obviously one of the channels through which they could potentially do this. But Dr. Kaberuka, so our first question really is financing energy projects in general, and why it's so hard to get it right. I mean, what from your experience, why isn't more money going towards energy, which is critical for our industrialization and for our communities?
Thank you. Good morning, everyone. Can you hear me?
We can, yes. Well, we can't see you anymore. We could see you earlier, but we can't see you anymore.
I don't know why. Let me try. Sorry.
There, perfect. Yes. Yeah.
Can you see me now?
Yeah.
I have to use two systems.
Excellent.
Look, I think everything has been said, but I have 4 comments I'd like to share with the panel. Ethiopia has just completed the Renaissance Dam. That is a 5.1 gigawatts. Can you hear me?
There's an echo, so I don't know if you're logged in twice, but we can hear you perfectly.
I don't know what's happening with this. Can you hear me now?
Yeah, we can hear you, yeah.
Okay, so I was saying Ethiopia just completed a 5.1 gigawatt Renaissance Dam. That is about 5,150 megawatt of electricity. It is the biggest in Africa since the Aswan Dam in Egypt. It is one of the 20 biggest in the world. One of the 20 biggest dams in the world. Now, 2 things are important for us to recognize. Number one, not a single international donor agreed to fund it. They all had a number of reasons, which I can go through if you wish. The lobby against building the dam was very strong. And so this dam, which cost about $5 billion, has been done entirely by domestic Ethiopian resources, except to my knowledge, a bit of funding from the China Exim Bank for the turbines, and I think a bit of interconnection with some of the neighboring countries, which the FDB did. No single external donor was willing to support this project. Now that shows you the problem. Now, a lot of arguments were put forward, the environment, social issues, stability of the Nile, and so on. But once you put these aside, which could be taken care of, my own calculation is that Ethiopia now has got a source of stable foreign exchange earnings, which it could not have got from coffee and tea and hides combined. So it will not be simply a source of energy. It will be also a source of export revenues, helping Ethiopia close its current account. I'm saying this because not every transformational project in Africa will always attract external funding. It was extraordinary how international organizations under pressure from different sources failed to support this transformative project, the biggest in Africa. Now we can go through the reasons for that. The second thing I wanted to say, so the Ethiopians funded by domestic bonds, the Commercial Bank of Ethiopia, other forms of domestic resources, and as I said, a bit of borrowing from the China Exim Bank, but largely it was Ethiopians who built this dam. The second point I want to make was that I said to another meeting in Luanda, which I think Amin referred to, that power is about what I call 3 A's. It must be available, so it is availability. That's one. But beyond being available, it must be accessible. That is second A. Beyond being available and accessible, it must be affordable. That is the third A. I've written about this somewhere. You can look it up. And often the challenge of financing these projects is somewhere around these three. Because putting turbines in the water or putting up solar panels, things they can do, people can do this. But there have to be an off-taker. There have to be a buyer who is financially sustainable. And far too often, these national off-takers, like ESCOM, for example, in South Africa, is financially weakened by attempts to make energy affordable by giving hidden subsidies in terms of very low prices. So energy is available, but in trying to make it affordable and accessible, you undermine the balance sheet of the off-taker, and therefore there are no incentives for people who build and transport power to build. This has been a very, very big issue. I recall when we were trying to help ESCOM increase capacity, I think this was a loan about $2.6 billion in FDB and the World Bank. The really big issue for us was the financial sustainability of ESCOM, not to find money or to put turbines and boilers where they should be. So that is an issue, which I think people should bear in mind. The third point I want to share with you is that I think someone mentioned this here, and I think that's a good point, that not every country can be energy independent, not in Europe, not in Africa, at least for now. So the efficient energy markets, regional energy markets, and that regional cooperation is very important. And I think that the Southern Africa Power Pool, West Africa Power Pool, some interchange in East Africa has gone a long way, but we have to do more of that, more of the energy markets. And when it comes to energy mix, which I think is a sterile subject, should it be gas, oil, coal, or solar? It will vary from country to country, because Africa has plenty of all those. It's plenty of gas, hydro, solar, wind, as you can see with Turkana project in Kenya. So every country will have a different mix depending upon its the availability of those resources. And very finally, the point I want to make, I think someone made it. As you move forward, it can't simply be about 600 million people lacking access to energy. It must be the industrial capacity of Africa. How do we power the transformation of our continent? And that requires more than what 600 million people need to light their houses. Okay? You know, Omar, when I was in Tunisia after the revolution, 2010, I traveled around Tunisia, especially the western part of the country near the Algerian border. And there we had funded a project which had made power available to light people's homes. But I realized that the phasing of the power did not allow even to have a simple machine to process fruits, all right? So there was light, but there's no power. And I think that is critically important, especially at this time, when we're trying to develop our critical minerals, when we're trying to develop things like data centers. You know, data centers are very energy intensive. So we need just more than power to light our homes. We need the power for transformation. And that means we have to harness all sources in the energy mix, depending upon the availability of all countries. And then we have to develop regional energy markets. So over to you.
Okay, so The bigger, let's say, thermal energy projects, nuclear, gas, etc., require bigger investments to some extent. So where's that money going to come from, especially if it dries up from international partners? Is the energy bank a good idea, for example? Was the AFDB right to push back when it was told that it couldn't finance gas? Now it can, but to be able to finance the gas industry, to be able to power the continent.
I really believe that we'll have to be very pragmatic on these issues. For example, in the statutes of these international institutions, yes, they could not fund nuclear power. That was in the 60s, for reasons you can easily understand. But the way technology has moved forward now, and the energy needs around safety, around modular power and all this, it is probably time that international institutions took a second look at how to fund nuclear power. I think many countries will be going in that direction, especially given the way technology has made this now feasible. Now, as for the doctrinaire position on gas, I think the recent crisis in Europe has shown you the importance of remaining clear about how you balance energy security, energy independence, and sustainability issues. It would be absolutely ridiculous to say to a country like Mozambique or Tanzania or Senegal, who are finding a lot of gas, it's okay, you can have this gas and export it to Europe, but you can't use it to power your country's industry. It does make sense. So I do think that here we need a little pragmatism rather than doctrinal position, and look at the availability per country. And again, once more, the possibility of regional markets. I'm confident that once those institutional barriers are removed, consortium of financing to get this done is possible.
And in terms of the role of government here, I mean, they seem to be playing a critical role. So we're seeing countries like Egypt that seem to be getting power right, whilst other countries such as Nigeria, where the regulation and the regulatory environment is more complex, they don't seem to be advancing at such a quick pace as others. So policy is critical to get it right, would you say?
So precisely, this is the point I was making. Many of the governments get the regulatory policies wrong as they try rightly to make energy affordable. So example, in one country I know, in the region of Eastern Africa, so the hydro was not enough, and so they had to set up other means of generating power, which was based on heavy fuel. So they were buying power at about 21 cents per kilowatt hour. But to make it affordable, the national utility was selling at half the price. So which means half the price was a subsidy. But they did not work out the subsidies, either cross subsidies, such that wealthier consumers subsidize poorer consumers, okay? Or that the government directly put subsidy in the books. So it was the balance sheet of the national off-taker which was taking the hit. And over time, it was not able to invest in power. So I think that conundrum between availability and affordability is where the regulators be pragmatic. I think it is right that poor people have access to energy, affordable energy, but someone has to subsidize it. Either it is other consumers, cross subsidies, or it is the government directly through open subsidies, targeted subsidies.
Okay, lastly, before we go back to our panel, in terms of what's going on in terms of global geopolitics, so energy sovereignty is more important than ever, and being able to finance our own projects is more important than ever. So for you, the energy bank is a good idea, and what Amin was asking in terms of pension fund regulation or pension fund reform, so that more of that domestic resources can be invested towards infrastructure and more specifically towards energy.
So, Omar, you have to go back to the 1970s when you probably were not even born. In the 1970s, there were two major crises in the world. You had the dollar crisis with the devaluation of the dollar, end of the fixed exchange rates regime, and immediately followed by the hike in oil prices, the first oil crisis, which took oil prices from, I think, $3 to $12, and then thereafter $32. It was a huge crisis worldwide, which almost brought down many economies. At that point, even the UK went on a 3-day week, if I recall, because even coal was not available. And so at that point, countries in Europe, in search for energy independence and energy security, were very pragmatic. France went nuclear. If my facts are correct, I still believe over 85% of French power is still nuclear, which was developed in the 70s. I think Britain, at the time, leaned on coal until Libyan oil became available, which was helping to limit the burden. So I think we are in that phase where pragmatism will be very, very important as each country searches for energy security, not energy independence. I prefer energy security, not energy independence, because you can get energy security by interdependence with others. Now, funding can come from all sources. Institutional investors like the ones you mentioned, traditional investors, if the packaging is right. When I set up Africa 50 Infra before I left the bank, which is based in Casablanca, I had two ideas in mind. One was to have a window to prepare and de-risk many of those projects, which they are doing increasingly now, and then also try to leverage many other funders, including institutional investors, okay, including pension investors and so on. And so I'm hoping that we can create new institutions. I'm all for it. But it's important that in the context of the Africa Alliance of Financial Institutions, they work together. So I'm more interested in how to get these institutions to work on a common platform, because some of them provide project finance, others trade finance, others guarantee products, others insurance products. So if they come together as they have done now in the AMFI, as that will be a huge leveraging factor. Of course, if the energy bank can be created, fine. But I hope and expect that it also becomes part of the alliance of African financial institutions. Thank you.
Thank you so much for your time, and great to see you. And as always, very insightful and very contextualized in terms of your reading of the landscape. Thank you, Dr. Kaberuka. So back to you, Wale, to close with the panel. You've got about 15 minutes or so.
Yeah, thank you so much, Omar. A very useful insight as always with Dr. Kaberuka. So as I go back to my panelists now, Amin, I want to come to you. And as Omar said, we really have just about 15 minutes to wrap things up. And we also want to go to some questions from the audience. And I would like to encourage our participating audience to drop their questions in the comment field of the platform. Okay, so Dr. Amin, I want to hear from you. So let's talk about critical minerals on the African continent, and energy is required to extract these. So what's the smart thinking around how we bring the energy to do this? And then, of course, as you speak to that, maybe you can also speak to how we can ensure that we're not just extracting, but we're also processing these minerals.
Thank you very much. I think maybe just to say something about the financing before I move to the critical minerals. I hear actually the context that was put forward by Dr. Kaberuka, and of course we have discussed about the need to finance locally our access to energy, definitely, and even energy sovereignty somehow, extremely important. The role of the not only financing institutions, but also sovereign and wealth funds and pension funds. But there is another critical element that I did not touch on, which is the reform that we need nationally, but also regionally in terms of monetary policies. Because so far, our monetary policies in most of our countries are made ready to control and stabilize inflation, but they were not actually really designed to push for the creation of national or even regional capital markets. And without actually this reform, I think that despite all our efforts to mobilize resources through our pensions or sovereign funds, I don't think that we will be really succeeding. So there is a lot of work that needs to be done in terms of advocacy toward the central bankers and the Minister of Finance, so that we can really engage and kick off this series of reform that we need for the monetary policy and the fiscal policies. Now, going back to the critical minerals, I think this is really the critical nexus where the SCFTA meets as well energy policy, I would say, because we hold about 30 to 30% of world critical mineral reserve, that one, including the cobalt, the number, more than 50%. But we have historically captured less than 1% of the battery value chain because we lacked the reliable energy for processing. But not only the energy, of course, energy is one of the reasons. You have as well the issue of capacity, the issue of regulation, the issue of skills, and so on and so forth. So our policy shift for 2026 for us, I think, must be driven by Africa Green Mineral Strategy, which is the African Union. That should be the anchor tenant model. We should no longer issuing mining licenses in isolation, and instead we should really require mining measures, especially in the Copper Belt, for instance, and the Lobito Corridor, but also in Guinea, to serve as anchor tenants for new large-scale renewable projects. That's number one. That will guarantee as well high volume demands for energy, and will help to make a solar plant bankable. But when I say bankable, and I want to go back to what Dr. Kaberuka has said, it's unlikely that international finance would finance huge access energy projects, including even the World Bank, by the way. They would rather go for 20 meg, 50 meg, but none of them actually will go for gigawatt, projects like the one we had in Ethiopia. So that really requires that we invest and we push into the reform that I was talking about. That's number two. So we are seeing this work actually in the DRC Zambia battery zone, actually, and the data shows that processing battery precursors here using hydro-dominant grid results in 30% lower carbon footprint. That one is no. Now, in terms of extrapolation, and this is actually important, if you apply the lessons from other countries like Indonesia, that actually ban export and force downstream processing, they grew their nickel-related export revenue from roughly 3 billion to about 30 billions, in less than a decade. So we are well positioned to replicate actually this jump, but with a green advantage, I would say, and the green premium, especially because we have neighbors like EU that have put the CBAM. I don't really like the CBAM, the carbon border adjustment mechanism, which is now active, but at least we can actually really take advantage of that, especially in the green minerals. And then market grow as well, because the demand for lithium and cobalt is going to increase by 400 to 500% by 2040. So if we lock in processing capabilities now, we really do and take actions and make the decision to reform what we need to reform, we can really move from a volatile raw commodity market, which is where we are now, to a high-value industrial ecosystem. And that would become possible, I think, with the SCFTA, number one, with the Africa Continental Power System Master Plan that we are promoting, which aims, of course, at connecting the 5 regions, SAPP, EAPP, WAPP, COMELEC, and the other regions. That is very much possible. So we would be in a position of not just exporting raw rocks, I would say, but really exporting green industrial product powered by African energy. But all in all this will be possible only, again, if we decide, I would say, nationally, but also regionally and collectively, to push for the monetary reform that we need, that will help creating the financial markets that we lack. Apart from South Africa today, and somehow Egypt and Morocco, you hardly see proper financial market in this continent. And without proper financial market, you should forget about financing domestically our economic transformation. Thank you.
Thank you very much, Amin, for your insights on that point. I'd like to now go back to Paul. And I think, Paul, you have some thoughts about how we contextualize the variable renewable energy conversation in the broader context of energy and electricity. But as you speak to that, are you saying major miners, particularly in the Copper Belt and West Africa, becoming anchor tenants? I think Amin was speaking to that point as perhaps that should be a policy imperative. But your thoughts on the trends that we're seeing there?
Yeah, and critical minerals, it's interesting. It's a theme for us over the next couple of years. But the key point is really realism about the scale of the challenge. So the president of Zambia in December confirmed that he needs 10 gigawatts of power to triple Zambia's copper output, and pretty much will be the same will be needed in the DRC. So that's 20 gigawatts of power. The 20 gigawatts cannot come from renewables. It's as simple as that. There's no wind in the middle. Solar can work about 25% of the time. You'd have to have massive overbuild, things like that. So the real question is, how do you get an all of the above energy solution to those parts of Africa? From our side, we see that the Copper Belt's got a number of options. There's domestic gas, regional gas from Mozambique. There's the same gas from Namibia. There's the same gas from Angola. And there's potentially contributory amounts of gas in northern Zimbabwe and northern Zambia.
I'm just sorry to jump in, Paul, but I can see the possibilities. The question is, practically, how will this work? The bankability, if you like. Are the tenants, are the miners going to make the investments required? Who is going to pay for it? Just give me some context on how it works.
I'm getting there. So, for example, some of the miners pay about 17 US cents per kilowatt hour. Domestic gas from the African markets next to it over the next few years should generate gas to power at significantly less than that. And miners are very strong credits. So, if it can be put together where you have feedstock that's non-renewable, balanced and supplemented with the renewables when it's available, there is a belief that the Copper Belt can get done. But other than that, 10 to 20 gigawatts on its own simply won't happen with PV.
Okay. Well, thank you so much. Thank you for clarifying that and sharing your insights. If we do have questions from the audience, we'll be happy to take them now. So I do see a few. Albert is saying here, I am manufacturing solar panels. Okay, just give me a second to read through some of these questions, and then hopefully I can pose them to the panelists. Okay, just skimming through them now. Okay, so I'll just throw this out to the panelists, and hopefully someone can catch this and provide some insights. So Albert is making a point that he's manufacturing solar panels and accessories locally and cutting the cost of imports. So what advice can he get from development banks, since it will improve energy availability and affordability? So making an investment in local production of renewable infrastructure. Any thoughts on that from any of our panelists on how that can work? I mean, do you want to take a stab at that? How do we incentivize local production? You are muted, I mean, so we can't hear you.
Okay, how do we incentivize local production? I think if you see today, first, he is making solar panels. So I believe it's an assembly plant. That's actually the way, because most of the technology, the R&D behind that is mostly coming from China. The best way actually to do that is to connect eventually its entire, I would say, how can I actually put it? The best way is, number one, for to advocate for the government locally to make sure that they have what it takes in terms of fiscal stimulus. That's extremely important. If you compare with China, I was actually watching a video yesterday that was explaining how China become the biggest producers of EV. Government subsidies are important, even in terms of just fiscal, I would say, support. That's number one. Quite important. And then number two, take advantage as well of the ACFTA, because if you look at today, I think that making solar panels and eventually selling that within the region could be a very good way for him to export regionally. And then number three, which is as well quite important, for him to get the incentives, is to make sure that to look into most of the African countries. You see today, let me take the example of Chad. It's a very good example. They have cut all the import duties on solar panels and anything related to renewable. And of course, utilizing ACFTA today would definitely help him to go and to export regionally without necessarily having to worry about import duties. So there is a lot of avenue for him, I would say, but most importantly, as well, at the country where he's operating, I think there is a little bit of work that needs to be done with the government to see how they can eventually put in place the kind of policy that can help incentivize the local production and the local manufacturing of solar panels.
I thank you for your response. And I think this really speaks to a broader theme that you spoke to, which is energy sovereignty. Paul, perhaps more so because you're a banker, I wanted to hear your thoughts about this, because I think the clear advantage that many producers in China would have over most African countries is the cost of capital financing. Is there any smart thinking around how local capital or finance can be cheaper on the African continent for people who are contemplating projects like this?
I can't talk about solar specifically, but I can talk about local capital markets. In most of the markets we operate in, excluding the big ones, the South Africa, the Nigerias and so on, the private sector single obligor limit is round about $250 to $300 million of individual African markets. That can get you quite a lot of stuff. It can get you small-scale LNG, it can get you downstream storage, it can get you trade finance for petroleum products, it can get you a lot of renewables. So that is quite sort of helpful. But in terms of individual countries making catalytic breakthroughs, that's where you really do have to rely ultimately on external capital. And that's what Amin has been talking about, one of the constraints very well. And to really break through the ceiling, it's really an issue of can you get external cash flows which can raise external dollars, that type of thing. That's obviously very easy in oil and gas projects. It's very easy in mining projects. The Ethiopian case that was referred to is equally fascinating, where dollar revenues can be earned from selling electricity abroad. But in essence, that's the broad constraint, which is the limited size of an individual African capital market. And one thing we shouldn't forget in the debate around should pension funds and this type of stuff be put into infrastructure is really one of the core roles of pension funds is to achieve diversification. So if a pension fund is just putting its money into local projects that are linked to bad utilities, there's every risk that pensioners may lose money. Whereas if the pension funds are in US equities or Swiss equities or Australian equities and so on, there's every chance that individuals may have more savings at the end of the day. Thanks.
Thank you so much, Paul. And Reginald, as we begin to close things out, if you can speak to this in less than a minute. Earlier, we were speaking about the bankability of grid power, essentially. And I wanted to hear your thoughts, just speaking broadly now, about the trends you are expecting in 2026, that you're anticipating we would see in the generation of power from the grid on the African continent.
If I'm to talk about what I see in 2026, one of the key focuses as a DFI that we're noticing is that the tightening of sovereign balance sheets, right? The fact that, in 2025 and a few years before that, fundamentally altered the way energy infrastructure is financed, think that's going to be critical going forward. It's complex. What we've seen is a higher debt service costs. We've seen the constrained fiscal space, and that continues to be exaggerated. And not just that, but the increased scrutiny from markets on the fact that governments can no longer rely on traditional blanket sovereign guarantees to unlock large-scale power projects. They just don't have that capacity to be able to do that. And so against this backdrop, what we've seen at TDB and what we're doing is we kind of now moving away from debt-heavy, kind of state-backed models towards structures that kind of link financing to outcomes, performance, and shared risk. And so there's an increasing emphasis on innovative PPP models that distribute risk a lot more intelligently across stakeholders, and not just the traditional PPP model, but something that really focuses on providing what's best placed to deliver, what's best placed to absorb risk. So in saying so, what we're pushing for, and I think what will happen in 2026 going forward is hopefully policy clarity, regulatory stability, given that you've got power pools and importation, exportation of power, land access, permitting, and just also time-bound support. I mean, it takes so long just to deliver a project, right? You're talking, 4 or 5 years to get financial close. It's just too long, and so we need to catalyze that going forward, and that's important. So we need clearer rules rather, and just also more predictable frameworks. And I think that's important. And so what you see is more so development banks are starting to play a far more catalytic role in providing, longer term debts, providing concessional funding, and that's important. Structuring expertise to ensure that risks are allocated more efficiently, and not just that, but they're allocated to parties that can best manage them. So those are things that I'm seeing more and more. I think blended finance is going to become an important part of the toolkit, especially in the current environment. Just combining balance sheet, concessional resources, climate funding. That's going to be important. And I think as one of the challenges we have on the continent is just our ability to reconcile reality and perception, right? The perception that we live in highly, risky markets, and I think the cost of capital kind of it reflects that, and I think we need to reduce that cost of capital. Not just that, but also just let's not transfer undue risk to governments. We have utilities that sign 25-year PPAs, and clearly that their obligations to deliver on those PPAs is very limited. Right. What we see again, I think going forward, what I'd like to see is improved system reliability. Obviously, going back to Amin's point on reduced emissions intensity, that's important. But most importantly, expanded access, just reinforcing the link between financing and outcomes. And the idea is to use concessional capital to kind of accelerate that going forward.
Thank you, Reggie.
Yeah, thank you. No problem.
No, thank you for those insights. I would like to allow Emma have the final word as we close things out. And just looking again at the Just Energy Transition Partnerships and the future of that in 2026, given the perceived lack of firepower that we're seeing from the West these days, what are your thoughts on how that impacts climate financing in 2026 on the African continent?
Sure. So I'll keep this very quick.
Real quick, if you can. Okay, we lost. I think there's an audio issue here.
Can't hear me?
Yes, I can hear you now.
Okay,
must be some kind of contact issue. Real quick, if you can, please.
Yes, of course. So I think really I would pick up and build on some of the points that Reginald was just making, because I think those are very relevant when we think about JETPs. The thing to remember with the JETPs is these are ambitious long-term plans, and how we measure their success depends also on sort of prioritizations from the government. So we have to understand that there are sort of key projects that are part of JETPs And so we need to see throughout the implementation, what are the priorities of the governments in South Africa? We see transmission grids, economic development, skills development. Those are some of the things they're prioritizing. Senegal, they only just released the investment plan, so we're going to see how that evolves over the next year. But key to implementing these projects is going to be a clear risk allocation between public finance, which we know is limited, private finance, which we know is limited, and bringing in domestic private finance. And so there needs to be a really considered conversation between those different financing partners to understand what is the most effective risk mechanism, risk mitigation mechanism, which are the risks that domestic partners are most concerned about, and how can we use the limited public resource to make sure that governments aren't taking on too much debt, and that those domestic private finance resources, which we know are essential to scaling up energy systems, can really effectively be brought in. And the final point I'd make on blended finance is what we've seen so far with blended finance structures is they've been effective at one-off projects, but we haven't seen this kind of scale and ramp up of those that I think many would have liked to see. So it's also this question of how can we make sure these structures are replicable throughout both the JETP program and beyond that.
Thank you so much, Emma, and thank you again to all our panelists for your very valuable insights. It's been clearly an informative session, and we look forward to better days in 2026. I imagine it will be a challenging year, given where the oil price is headed. But I believe that with some innovation, with some partnership, it should still be a very good year for the energy space on the African continent. We want to thank all our participants for joining us for this engagement, and it's the latest installment of the Africa Business Energy Series, and we look forward to having you at the next event. Thank you so much, everyone, and enjoy the rest of the day, and Happy New Year.